Good morning and welcome to the Killik & Co market update. Markets have had a strong run recently with US indices hitting a number of new record highs. Corporate results have been very strong recently and there's been good progress in the rollout of the vaccine in developed countries. However, this week markets did have a little bit of a wobble, with the S&P 500 dropping nearly 1% on Thursday this week. There was no obvious single cause of this, but it could potentially be investors taking profits after such a strong run. It could be worries about the Delta variant of the coronavirus, or it could be worries about social restrictions in some countries being lifted too quickly. Also this week we have seen a reduction in US government bond yields, implying that investors are buying bonds, and this has caused quite a lot of confusion among some analysts because bonds are not an attractive asset to hold when inflation is rising, as we're seeing at the moment. The reason being that bonds pay a fixed rate of return which does not rise in line with inflation. We've been taking a look at the VIX index, which gives an idea of expected future volatility of the market. So here's the chart over the last 2 years, and as you can see there was a huge spike in March last year, and generally the VIX has fallen since then. However, it has started to pick up over the last couple of days. A VIX level of 20 is generally associated with heightened volatility, and as you can see we're slowly approaching that level once again. US markets are expected to be up again this afternoon when the market opens, so it could be that yesterday's fall was just a blip, but we'll be watching very closely to see where markets go from here. Inflation is still very much on the agenda, and there has been some concerns that central banks around the world will raise interest rates in order to combat this inflation, and there has been worry that these higher interest rates will restrict our recovery from the coronavirus. However, this week the European Central Bank has changed its inflation and interest rate policy, allowing it to leave interest rates lower in the face of higher inflation. Since 2003, the European Central Bank has had an inflation target of just below 2%. Here's a 5-year chart showing the actual inflation rate, and as you can see, it spent a lot of that time quite far below the target rate, and at times it's even dropped into negative territory. However, recently the inflation rate has spiked owing to the recovery from the coronavirus as the economy has started to reopen. This week, the European Central Bank changed its inflation target from just below 2% to 2%, and it also said it would allow the inflation rate to rise above that target for limited periods of time. So what this does is it sends a really strong message that the European Central Bank is very keen to leave interest rates lower for longer, and historically that has been very good news for stock markets. And finally, there's been a lot of talk recently about Chinese companies that are listed on US stock exchanges, with the US calling for stricter audit requirements for these companies. Last week, Didi, which is often referred to as China's answer to Uber, listed on a US exchange, raising over $4 billion in its IPO. Initially, the shares performed well, and the company briefly had a market capitalization of over $68 billion. However, over the weekend, it was announced that the Chinese regulator has accused the company of improper use of customer data, and it's banned the company from taking on any new customers until its investigation is complete. Initially, it wasn't clear whether the investigation had only been announced after the IPO, or whether the company knew about it beforehand and decided to keep it quiet until after the IPO. It's now thought that the latter is more likely to be the case. US senators are calling for an investigation, and this will do little to help the strained relations between the US and China at the moment. Moving on to have a look at next week, it's quite a big one for US banks, and we have results out from JP Morgan and Goldman Sachs. That's it from us. Enjoy the weekend, and we'll see you next Friday.